All right. I'm going to send out one more message in just a second here. In a second, I got to reopen the chat. That got closed down. Getting all sideways right now. Beautiful day in the markets today. Hopefully, a lot of you got to get in on some of the action. Let's see, take a quick peek at the indices and see how things closed. S&P, new high, beautiful. Qs, same thing, new high. IWM, getting ready to set new highs. The Dow getting ready to set new highs. Let's check RSP getting ready to set new highs. Yeah, I mean, everything's set up. You look at Apple rejected that breakout a little bit today. Microsoft getting ready to start moving. Nvidia new highs again today. So this whole market continues to look like it wants higher. It's continuing to provide plenty of opportunities. All right, I'm going to send out one more message letting everybody know we're getting started. Good for you guys for being here so early. I appreciate it. I mentioned it a couple times today, but I can basically guarantee you that every single person in here tonight is going to learn something new. If you don't, I'll be incredibly impressed and ask you to maybe teach the next one because I can almost guarantee that I'll be learning something tonight from River or 1K myself. So hope you guys all feel the same way. It should be a real fun class, and we'll talk a little bit more about it in just a second. I'm just sending out one last message. This absolutely is important to every person in this group. Okay. All right, and River's supposed to be here shortly, so maybe he'll stop in a little bit later, but he is supposed to be here. He said first 30 minutes tonight. Yeah, dirty reindeer, river, clean river, whatever you want to call them. All right, everybody. Well, welcome in. Welcome to the lecture for the evening. Like I mentioned a little bit ago, tonight is going to be on risk management. And this is a concept that unfortunately a lot of people don't fully grasp the importance of. Fundamentally, risk management is just about the most important thing in anybody's trading. It doesn't matter how good you are at maybe technical analysis, fundamental analysis, quantitative trading. It doesn't matter at all. If you're unable to manage risk, you're unable to properly balance your portfolio, you're never going to be able to be long-term profitable, long-term successful. And in most cases, you won't even be successful for more than a couple months at a time. So this lecture is certainly going to be valuable for traders of all levels of experience. And I can almost guarantee that, at least half or more of the people that I see message and type and trade for could benefit from the content that we'll talk about tonight. So doesn't matter what level of experience you're at, I can almost guarantee you're going to learn something tonight. We got River in here now. Welcome in, buddy. Tonight, we're also going to be joined by River and 1K, who are making a really, really nice appearance tonight. They're taking some time out of their day to spend a little extra with us. So make sure to show them some love for being here. Couple things to just talk about before we get started. This is going to be the 9th lecture in the intermediate course series. So 9th out of 12. We're rounding the bases here. And we got these last 4 lectures, kind of like I was mentioning earlier, should be really fun. I'm hoping to get a lot of our analysts and support team in here to talk about some different concepts. That way we can get a really rounded out kind of set of experience, especially when we get into lecture 11 and we talk about different trading strategies. And as a reminder, 2 main goals of the intermediate course series. First one, this is a course series that's more focused for traders that are going to be at a more intermediate level. So as a result, I want to improve the skills of traders who have a baseline understanding of technical analysis and stock market basics. So in general, for most of the lectures, I'm expecting people to have a good head start on, what options are and what the Greeks are and what a stock is, what an ETF is, and understand the basics of technical analysis, support and resistance, trends, that sort of thing. And then the most important goal, which is the second here, is to teach you all how to apply the techniques discussed in this course. I've mentioned this so many times now, and I can only repeat myself so many times, but nobody's ever going to learn anything from any of these lectures unless you actually start working on applying these concepts in your trading on a day-to-day basis. We could talk about support resistance or trends or entries or exits or risk management all day, and you could sit here and listen and drink the Kool-Aid, but none of it matters unless you actually go in and apply it on a routine and regular basis. And as a result, that's why we go through so many examples. We're bringing some of our different team in here to give different perspectives, and always open to any questions or DMs after the class. So just a quick recap of what we talked about in the last class for those of you who were here. Last week, we focused heavily on moving average systems. And just like anything, I'm never going to be able to go into the full detail and scope of what we covered last time. But the main focus that I had in last class was focusing on the power of just a simple 10 and 20 EMA and a 50 simple moving average and a 200 simple moving average. We talked about how some people might use different combinations, maybe the 8 and 13 EMA, maybe the 9 and 21 EMA. But these sorts of EMA combinations paired with some longer term simple moving averages have continued to prove as incredibly, incredibly powerful. You could call them indicators, but I don't think they're really indicating specifically. It's just an average of the price. Incredibly powerful indicators, and in my opinion, basically some of the only indicators that you need. My personal opinion is that this volume price and maybe VWAP, you really don't need anything else to trade, and you really shouldn't be using much else, in my opinion. So in last lecture, we covered a lot of different examples related to the power of these moving averages. We talked about when the short-term EMA is above that longer-term EMA, so 10 above the 20. Any name is in a short-term uptrend, and you can see how that 10 and 20 EMA zone, represented by this green and red cloud, can act as really strong support and resistance. And we focused on some of the most powerful stocks in the short term, or at least some of the most powerful stocks as of 2 or 3 weeks ago. But this concept is certainly something that has been applied over the last, even 100 years. You could go back and see charts that look just like this. So it has nothing to do with these specific stocks. It's a concept that you could look back on, all your Mag 7 names. You could take a look at something like Amazon and see how powerful these EMAs have been over the last couple of years. And even if you go back 20 years back to the 2000s, you could see the exact same idea. And I'm sure just where we zoom in, wherever it ends up, is going to continue to reflect the same power of these EMAs, right? When we have those positively trending EMAs, you're looking to get long, right? Here you can see a nice flag or whatever you want to call it into the EMAs, a little bit of a bottoming pattern here and a breakout as these EMAs begin to curl to the upside. Same exact setups, right? And this is 2000 and, well, I didn't make it all the way deep into the 2000s, but this is 09, right? This is still pretty far before this sort of data was so widely accessible. There's no Robinhood or iPhones publicly available to everybody. So anyway, this was a lot of what we talked about in last lecture. Since we have so many other people in here, I don't want to spend too much time covering it. And if you want more detail, certainly go back and check that lecture out. So the focus of tonight is going to mostly be on risk management. And 1K and River are here to help kind of further this discussion. The idea of tonight is we're going to start with a couple different, I'll say, examples in the PowerPoint. And we might branch out from that, but it's mostly meant to be just some different talking points. We'll probably flip between the PowerPoint and the charts as needed. But mostly we just have some talking points and we'll go from there. And River and 1K haven't seen these slides, so they might have some different things that they'd like to cover, and that's great. And we'll certainly go in that direction. Okay, so the first thing that I wanted to start with was actually a question to everybody else in the chat. So when you think of the term risk management, what are some things that come to mind? What are some things that you think of? And it could be related to finance, it could be related to training or trading, it could be related to maybe just, general parts of your life. What do you do to manage risk in trading? What do you do to manage risk in your life? Why don't you go ahead and drop some of those in the chat? Some of your ideas of what risk management might look like to you. I'm sure everybody has something. So what do you guys think? You guys can also unmute. So Tiffany says controlling loss, protecting money, not gambling. Yep, River says stay off trade floor. Knowing you'll exit before you enter. Sticking to rules, managing position sizes, stop losses. Yep. Ignoring the hype names. Yep, absolutely. Moderation, listening to Norvin. Nice. Yep. Sounds like you're not doing a great job at managing risk if you're listening to him. Wearing a helmet while riding a bike. Yeah, absolutely. Yeah, these are all great examples. And I think one of the most interesting things about risk management is it looks different for different people, right? Different people are going to have different levels of risk tolerance. Like, for example, if you're riding a motorcycle, some people might think they're managing the risk of death by wearing a helmet. And other people might think they're managing the risk of death by slowing down a little bit and keeping the helmet off because the helmet limits how much they can think, right? So risk management looks a lot different to different people. It really depends on your risk tolerance and what you're able to handle, and especially the money that you're trading with. If you're trading with money that's absolutely important to you, and if you lost it, you're screwed. I would expect your risk tolerance to be pretty slim. But if you're trading with house money that you couldn't care about, well, your risk tolerance might be a little bit loose, and maybe that's a problem, maybe it's not, but that might be how you operate. So tonight we're going to talk about a couple different themes. I can't remember them off the top of my head, but managing risk when it comes to losses, entries, just general trade management. And we're going to use some of the things that come up on screen to just help guide our discussion tonight. So I want to start with losses, and I don't have this order memorized. So the first thing that I have to manage risk on here is to cut losses immediately. And this is going to be one, I know River can certainly weigh in on this because he does this super religiously when scalping. And I even saw what you wrote in your tab recently. River, you want to weigh in a little bit on this? I know I'm kind of putting you on the spot here, but and this isn't even your point, but yeah, what are your thoughts here?
It's like the most important part of trading. And nobody does it. That's the problem. I think the biggest like issue people have when it comes to cutting their losers is you're admitting the money is gone. And I think that's really, really hard for people. We see it all the time. You're holding these trades down 30, 40, 50%. No reason to be in the trade, but you're holding it, hoping that it's going to come back for you. And we've all done it. I mean, I'll be entirely honest. I got some SPY contracts in my portfolio right now that are minus 99%. Should have been cut, but it is what it is. You need to not do that. We all do it. Like I said, I'm guilty of it, thankfully they're cheap, but I'm guilty of it. But people need to just start admitting they are wrong. And that's where it's so hard. Everybody wants to puff their chest on trade floor or whatever it is and say, I'm the best and blah, blah, blah. And, oh, we're down 50%. This is part of the plan or whatever. Don't do that. Just admit you're wrong as quickly as you can. When I scalp, obviously, and you kind of mentioned it in my tab, we'll admit we're wrong in like 3 minutes. Sometimes we'll buy at the beginning of a candle and we will be stopping out by the close of the candle because we aren't getting what we wanted from the trade in the time that we wanted. And I think so many people have trouble because you're admitting you're wrong, which people hate to do, and you are also saying, okay, that money is gone. That money is not
Mhm.
coming back. And I think that's what's so hard for people. Clicking that sell button, it's the most difficult thing for a new trader to learn is clicking sell when you're red. And people just get into that vicious cycle of, maybe they have a 50% trade come back for them. And so they just get in this habit of holding them when if, cut that trade, you're down 15, 20%, 5% in some cases. When you're wrong, you're wrong. You got to click that exit button. And, I'm lucky enough, and I've talked about it a lot that, trading psychology, because I had experience in trading before I started trading options, has always been something easy for me. When I'm wrong, I'm wrong. I just cut it, it's no big deal. And that's what I, always want to try to teach people and always talk about, and your 3 words say it best: cut losses immediately. Like the second you're wrong, stop. That's it. Like
Mhm.
just stop out of the trade, find a new trade. If you lose 20%, who cares? 20% is easier to make back on the next trade than 50%, 70%, 80%, So just admit you're wrong and move on. Nobody's gonna remember tomorrow if you stopped out or if you hit 1,000%. Nobody cares, so always follow your plan and admit when you are wrong as quickly as you can.
Right. And I don't know how often you guys hit, 100% trades. I assume it's not super frequent, but if you let a loss move down to, 40, 50, 60% red, all of a sudden just to break even, that trade needs to do 100%. And again, I don't know how many of you are doing that on a daily basis. I can certainly say that it's not me. But that's pretty significant, right? Just to break even, you need that contractor stock to double. You're up a creek in that situation, right? You really got yourself in a pickle there, and that's why it's so important to not let your loss get to that level, unless it's within your plan. Of course, people like River sometimes will take a contract and say I'm sizing for zero. If it goes to zero, whatever, I don't care. But yeah, all excellent points, River. Anything else to add, 1K?
Yeah, kind of piggyback on that a little bit. Things I'm seeing, been here 5 years. Things I see on trade floor and DMs is, um, when we scalp with River, like as an example, at the end of the day, we're getting like a contract that's, literally 16 or $15. Not that it doesn't matter, but we just play a little bit loose because it's, 15, $12, and hopefully you're up on the day. But what I see people do is, kind of goes into a trade plan topic, but they get in. I'll just use Tesla and SPX because that's always the port killers. But they're in a position size so heavy that when they see that red, you're down $200, $300, $150, and like that's a lot of money. That should be a lot of money for anybody. And I think what happens is, like kind of River said, they don't want to accept the loss because like, well, shit, that's a lot of money. I didn't expect this to happen. Kind of again, no trade plan. And when shit goes against you, that's when you really freak out. And I think people, you could, it would suck to lose $150, but you could cut that and just move on from it. And that was the one quickest things I learned early here in OT is like when you cut a losing trade, it's a great feeling. You can just move on. The markets are still open. They're going to be there tomorrow. Like just it's the trades you just hang on to day after day that just bleed out, and it just ruins your mentality. Because you start the next day knowing you're down on whatever trade it is, but you think it's got 3 weeks of time, it's going to come back, but the whole time you could have cut it and just moved on and just mentally felt better with it.
I agree. And I love what Rob said in the chat too. He says, what helped me is knowing the level or price you're willing to cut at before you enter. That is arguably the most important part of this is that you're able to cut losses immediately when you know exactly when you're going to cut. And that also helps your psychology too, because you're almost accepting the fact that, hey, I might lose 5, 10, 15, 20% on this trade. But when you plan that in advance and it comes true, it's like, you know, whatever, life goes on. Right, and what I've been doing recently that I've been finding to be, I don't know, pretty solid, is on some of my trades. What I'll do is when I plan it out, I'll just put the level on the chart, so I don't forget, right, and I don't have any excuses. So my stop's set right around this 195 spot. My entry's around this 209 spot. So I know if we break that 195, 196 area, it's time to run the other way.
Well, and yeah, and I gotta point out, I mean, what Rob said is like that should be a given. Like if you don't know where you're gonna stop out when you're entering a trade, then you have like no business entering that trade. Because if you don't know where you're gonna stop out, you quite literally don't know how much money you have at risk. So you have
Mm-hmm.
no idea to be like you can't analyze how much you're risking against how much you're going to make. And so if you don't know that before you're entering all trades, you should not be taking a trade. What I always teach is there's three parts of any trade in its simplest form. There's entry, there's stop out, and there's take profit in that order of importance. Entry is everything. Well, especially for options traders, what I say is you can turn a
Right.
good trade great with a good entry and keep a bad trade not too bad with a good entry. Then the next most important thing is your stop out level. If you don't know where you're planning on stopping out, you don't know how much money you're putting at risk. And if you don't know how much money you're risking, you should not be putting on that trade. Then finally, you figure out your take profit. And if you're risking $20 to make $10, don't take that trade. Or just to, bring up those absolutely crushed trades. If you take if you have a trade, it goes minus 50% or we'll say 60% for ease, it goes minus 60% and comes back and pays you 20% and you celebrate it, or maybe it's an alert and you call the analyst a goat. You risked 60 to make 20. That is a horrible risk reward. You have three risk and one reward. If that's how you trade all the time, your port will get wiped out rapidly. And so if you don't know that stop out level and you don't know an early take profit level, you have no idea your risk reward and you really shouldn't be in that trade.
Yeah. 100%. And that's, I think, a problem that a lot of people have is instead of having a defined stop, they just freak out when it's red and say, oh, it's red. What am I going to do? Am I going to keep holding? Am I going to average? Anyway,
Well, and
excellent
some that
discussion.
some that I was even talking about recently, it kind of plays into like, cutting your losses is greed is a funny thing because I was discussing it as, obviously people get greedy and they're like, oh, I'm up 400%. Should I trim? They'll say things like that. Well, it works the other way. Traders, specifically newer traders, they have this weird thing where the more destroyed they are, the more confident they become in their trade. You know, they have this like minus 50% trade that's wrecked, and they're in trade floor typing in all caps, yelling at you for 15 reasons that they're still in that trade. And it's still a bad trade, no matter how you look at it. And so people have this weird thing where they're getting like greedier and they're getting more and more confident the deeper red they are. And that is not how you should be trading. Yeah, Tater,
Very
there's a
cool.
lot of people that that's that, you know, unfortunately, that's a lot. We see it on Twitter all the time, you know, people telling me that like, you're an idiot for buying calls. I'm in puts and I might be down 80%, but trust me, the market's gonna die. And it probably doesn't die.
Cool. We have so many topics to cover, so I'm going to keep rolling, but we can certainly come back to anything as you guys want. Okay, well, this is another one about stops, and this probably helps somebody figure out, they said where to set my stop. So this is another way to kind of manage or make cutting losses quickly happen. What I wrote on screen here is use technical stops near key price levels. For me, what this looks like is it could be a strong level of support, it could be a trend, it could be a significant moving average. No matter what it is, there's a significant technical area on the chart where if a stock breaks and closes below that spot, I know it's starting to break down or it's starting to move the other direction. It's very simple, right? And I could probably look and see some recent trade. What did I get stopped out on recently, River? A lot, but I
Soundhound,
guess it.
Soundhound, Rocket Lab,
Oh yeah, well, sound I was in profit, so this one doesn't.
Roblox. That was a long time ago, but I'll always remember.
This was actually an interesting one that I got stopped out on recently, and I actually sold a little bit early, funny enough, and it ended up working in my favor. Long story short, I had my entry around this $50 spot, break and hold above there, and my stop was at previous day's low around 47.60. And the plan was to stop out on a close below. I actually basically ended up stopping out right there. We were going into FOMC, and I was like, I kind of want to take some risk off, and this name's underperforming, so I'm going to take it off the table. It ended up moving 30% from the stop out, but that doesn't matter, right? Long story short, my stop was a key technical level. And while I didn't follow it, that's my own problem. That's a separate conversation, but it's simple, right? If we close below this, breakout bar, bull bar closing near its high, breaking above the prior range, breaking above the EMAs, we close back below it, it's a failed breakout, right? By all intensive purposes and definitions, the breakout has failed. So there's absolutely no reason to be involved anymore. And as a result, it'd be time for me to cut. So that's one example of how I've implemented this concept recently. 1K River, what do you guys have?
So I did nothing really other than, obviously all of your stops should be technical. I saw somebody mention it in the chat that they always have a 10% stop loss. Well, one, you're going to get stopped out of like 90% of your trades with a 10% stop loss. And two, you can never base a stop loss on percentage. If you start trading your, we describe it as trading your P&L, you're trading because you're red. You aren't trading because of what the chart tells you. And
Right.
everything we do as traders needs to be based on something that the chart tells us to do. Tostie trades shares a lot, obviously he'll have options on occasion, but trades a lot of shares. We as options traders have it a little bit more rough, because we're fighting things, delta, theta, gamma, all of the things that work for and against us. It can be hard for us to set hard stops because a little wick can tag you when you should not get stopped out and you get stopped out. So the best thing you can do as an options trader is really, again, it goes back to analyzing that risk, understanding if I have to stop out below this technical level, how much money am I going to lose? And that's, just wraps both of these together of this is why you need to do that. It's also why a lot of us that trade options, again, it's a little, you have definitely a lot more wiggle room with shares. You want to be entering around where you think you should be stopping out because that reduces your risk and increases your reward. So that's, all it always comes back to being patient in this game. Trading is 99% doing nothing and doing the right thing for the 1%. You actually have to do something. And so always watch those technical stops and try to enter as close as you can. And that will dramatically reduce your risk on options.
1K, anything?
Yeah, kind of just rehash what you guys said. I mean, everyone kind of trades different, charts different, but I try and enter. I mean, this is going to sound super obvious what I say, but I enter next to the trade, and where my stop is, it is obvious when it hits that the play is no longer valid. Obviously, that comes down to trading psychology. You have to stop out, but I try and enter trades, and when I type up something in my tab, I hint like, "Hey, here's my stop out. If we break, if I'm in puts and we break over this, I'm in calls." Because I want you guys to look at that chart and go, "Okay, well, why is it not valid for puts? Okay, it breaks over this level." And I want you guys to look at it and say, "Okay, well, obviously every time it breaks over this level, it turns bullish." And so that's kind of what I do, in my tab, to try and just make it as obvious as possible. So, you guys can ask questions, but that way, I don't know, I just try and teach best I can in my tab, and make it, yeah, just super obvious when to stop out, I guess. I don't know.
Cool. All right, we're gonna keep rolling. We got a lot to cover. Great discussion so far, though. Okay, so shifting gears a little bit. So we've talked a little bit about kind of how to mitigate your specific financial loss. Obviously when a trade goes wrong, or even when a trade goes in your way, it's important to have that stop. Now I want to switch gears a bit and talk a little bit about managing open trades. This is River's probably favorite. We've been talking about this a lot recently. And who is this quote from? Is this William O'Neill or is this somebody else? I can't remember.
Tutor, Paul Tudor
Tutor.
Jones.
Okay. Okay. And yeah, very simple quote. Losers average losers. If you are in a trade and you didn't plan to average before you got in, you should never be averaging. Ever, ever, never, never, never average unless you planned to do that. Because so many people use averaging down or averaging into a trade to cope with the fact that their entries sucked or the trade went against them, right? That's all averaging does in 99.9% of traders. Now, 100%, there are incredibly skilled traders, specifically Shark is one of my favorites, who specifically plan to take averages when he's taking longer term swings and takes advantage of the fact that, contracts might get a little cheaper over time. Something might move slightly out of the direction that he's hoping for, and he can use that to his advantage. But it's very clear that that's part of every single trade he takes. That's part of the plan. For the majority of people, they just do that because they're red and they're like, well, maybe I'll make some more money. So hopefully I can get it back. River 1K, what do you guys think?
Yeah, I think that you should I mean, I trade the same, and I mentioned this in my tab. If I swing trade, I enter with a half a position, that's always what I'm gonna do. On any swing trade, you should never go full position. There's just really no point. You will, very oftentimes, even if you have a great entry on a swing trade, you might see those things get a few bucks cheaper, so it is worth it to always leave yourself some space in a swing trade. Worst case scenario, it goes the right way and you have a few less contracts, always leave yourself a little bit of room. And then Raphael kind of mentioned this. I'll also do it on some of my day trades. Anybody who's or swing trades, or sorry, scalps, anybody who's traded with me in voice chat. Fuck, dude, I learned so many trades.
Jesus, dude. Oh
um,
my God.
yeah, dude, it's insane. 90 trades this month. On my scalps and my day trades, you might hear me say something like, I'm getting a foot in the door. That means I'm just gonna grab a couple. And if it bounces against me, I know I'm taking an early entry, and I know that the real entry I wanted could still come. And so it's always worth it to leave yourself a little bit of room. But if it's not part of your plan, if you aren't getting foot in the door and you're just like, boom, full position, then you can't average. Averaging is not allowed. You have all of the money that you're willing to risk in there. And so you can't do anything to adjust that position. You have to let it work or stop out or take the profits or whatever shows up. But like Toastie said, if it's not part of the plan, you do not do it ever. We see it all the time where, people are wrecked. The worst reason ever to average is because you're down bad. I mean, you're not going to be able to buy yourself out of that trade. So you always, you only average for a reason when it's part of your plan. Otherwise, it's gonna go really, really bad for you. Average down the whole port and then it's gone.
Yeah, I mean, I'll be the first to admit that, I've certainly averaged a loser or two in my time, and River can attest to that fact. Um, the only thing that's going to prevent you from doing the opposite of a lot of the behaviors that we talk about tonight is your own mental discipline, right? If you can't prevent yourself from averaging down a losing crappy trade, that's your own problem, right? You need to figure that out within yourself. We can't force you to do a lot of these things, and that's why it's so hard, right? Is you could follow all the best alerts and take all the best trades, but if you manage them poorly, you're not going to be able to make any money because you can't limit yourself to do the behaviors that you're not supposed to be doing. So this in specific and a lot of the other things that we talk about tonight are all going to come down to your own discipline as an individual and as a trader to prevent yourself from averaging losers down, right? Because nobody's going to stop you. I can't, cancel the buy for you. River can't look over your shoulder, and he won't. But you need to figure that out for yourself, right? We can give you the roadmap, but you have to set rules or lines in the sand uh, that basically prevent you from making decisions such as this. Luigi's in here now. Luigi, I'm interested to see if you have anything that you want to add on this one. Same with you, 1K. I know Luigi might just be here hanging out and I'm putting him on the spot, so no worries if not.
No, you're good, brother. I'm here. I'm listening.
Okay, cool.
No, I agree. I mean, there's nobody better for everybody that's listening. There's nobody better to learn from than River and you. You guys are really really good at what you do. Um, I think a lot of people constantly ask me, my trades go red. When I take contracts 45, 60 a year out. Intentionally because I can't trade them during the day and they go red for 20, 30%. I mean, that Tesla trade went down to like 45%, but I was confident in the setup. Maybe it was a little early, but people that see red, they immediately start trading a year out contract like it's an intraday. So y'all just gotta understand that. You can't treat things the same way. Um, you have to be confident in the setup. Just because it's red doesn't mean it's not working out. That's what we grab time for my style of trading, which perfectly fine works for me. Doesn't work for some of y'all. Um, so you have got to trust the trade. You have got to um, limit averaging in. A lot of people ask me if I average in. I don't ever average in. I've done it 4 times in 4 months trading here in OOT. So that tells you how often I'm willing to average in because I'm going to take the position. I'm going to trust the trade's going to work out. And, I think 92% of the time it works out. So that's a little bit of gambling, I guess some may say, but no, there's a science behind the art, and I trust my charts. I trust my setups, and they don't work out all the time, but that's part of trading too. So um, yeah, I mean, I appreciate what River and 1K are doing here. It's two great guys for sure.
Awesome. Thank you, Luigi. All right, we're gonna keep rolling. I can't believe what time it is. We have so much to cover still tonight. I think I have a total of 10 and we're on number 3. So let's keep rolling. Okay, this is an interesting one. This might be a little bit of a longer discussion. This is another one on ways to manage risk, and it reads: reduce exposure in deteriorating market conditions. And let me define what I meant by this real quick. And just to be clear, Luigi, 1K, and River, none of them saw any of these before, so hopefully they agree with me here. But long story short, what this specifically refers to, and this applies maybe a little bit more to swing traders, maybe day traders too, less scalpers, is that when the market becomes less favorable for the way that you like to trade, it's time for you to begin dropping your size, right? And what that might look like is you taking 1, 2, 3, maybe 4 losses in a row. Probably means the market isn't very favorable for the way that you like to trade. Could mean that, or it could just mean that you're trading poorly or getting unlucky, and those things happen. However, in general, right, when you have an established trading system and you're following your rules to a T, once you start to see a little less traction and start to get a little bit more losses than normal, it's time for you to start sizing down, right? Because what that means is the market's a little bit less friendly to the type of trades that you're taking. And breakout traders might be the first to notice, right? As the bull market begins to mature, starts to develop some longer term, higher order bases, maybe it's time for names to start slowing down and consolidating a little bit. And if you're trying to trade every breakout, it might not be so profitable anymore. This one might not require a long discussion, but interested to see what the rest of you guys think.
Oh, dude, I completely agree. And we see it in here all the time. Euphoria gets serious with people. Like when you got well, We'll call them growth stocks, the nice way to put it. Ripping and everything's ripping, it makes these people just want to long them all and just long everything. It can work the other way or dumping, whatever it might be. And there's a point of diminishing returns. You start looking at these things that are up, you're like 1, 2, 300%, and they're up 1, 2, 300% on like hopes and dreams. They aren't up for a reason. They're up because that sector is hot. The more they rip, the less you should want to be in there. Um, what do I mean by growth stocks? I don't know.
We're
Hop
looking
on
at a lot
Twitter,
of them right now.
hop on Twitter and look at the most popular stocks on Twitter, and those are random growth stocks because some of them are putting in really big moves, and then dying. Yeah, Wolf, prime example. Why is Wolf up 3,000% in 3 days? For no reason. And yeah, AI data center stocks, IREN, CoreWeave, those kinds of ones are like, they're on the moon. And not to say they're bad companies, you shouldn't be invested in them, nothing like that. But big rips should make you build caution, not confidence. Because, generally speaking, with very large moves comes very large dumps. RGTI is another great example right now. Quantum was hot, then it flushed 13% in 2 days. You have to be very cautious on those things. Not to say you can't remain bullish, but you shouldn't want to be buying the big green candles. You should be wanting to let those dips happen, and they will happen. One thing that people always struggle with, they see these rips and they think they need to be in there, and then in reality, they should just wait, give it a second. You'll get another entry. And Tostie was discussing market conditions and how they change. I'm funny, and this not only applies to daily time frames, but intraday. I like trading ranges. I know most people don't like trading ranges at all. The market spends well over half of its life trading ranges. So on a day like today on SPY, I hate this day. Like this is not my kind of trading. Where things just grind up all day, they're just blindly buying, relatively low volume, terrible data. I don't love that. Yeah, what Toasty circled right there, that's what I like to trade. So, I would rather hit, 4 or 5 50% trades than ride this chop all day in one trade and try to make my 150% or whatever it might be on some spy calls. I would rather trade the range. It's easier. You don't have the volatility up and down. You have very defined risk and reward. I like that. So on a day like today, we caught a couple nice trades early. Obviously paper handed them, 995s or 695s for like nothing, or 665s for nothing. And then I shorted it twice. Got stopped out once, made some money the next time, and called it a day. I have no interest in trading that kind of stuff because I have a very, very strict rule. If it feels like you're chasing, don't take the trade. On days like today, that sucks because it exploded all day long and you could have just made money, just stuck long and never had an issue. The market very rarely does that. So most of the time, if you feel like you're chasing, don't take the trade. You are chasing. It's a very, very safe rule for your port. And so when we have these changing market conditions and we go from, we've had some nice pops here and there, but a lot of ranging intraday, and then we get the big old trendy grinder. I never do great on these kinds of days. It's just not my kind of trading. So understanding that about yourself. Understanding what the market conditions are handing you and understanding if this is not my type of setup, my type of trading, maybe I should be sizing down. Just like Dusty said.
It's such an interesting perspective too, because just based on the way you trade, but it just goes to show how people's risk management can look different, right? You're sizing down and slowing down on a day like today when most people would be running for the entrance, right? Getting in. And on the days that they're sizing down in the range days, you're probably getting involved really heavily, 5, 10, maybe 15 trades throughout the day. So I find that fascinating.
Let me, if I may interrupt, 1K and River, and I don't know how you guys feel about this, but I personally feel that we have also a great number of members that are always chasing whatever headline is on MSNBC or Jim Cramer or something, as the trigger to get into a position. And that is only good for 5 minutes of the day. After that, we've seen it where news absolutely wreck SPY. for a good 50 minutes, and then the rest of the day SPY recovers 100% of the loss on that headline. And that happens. I've seen it happen with one too many stocks. So I keep telling people, just trade the charts. Stop trying to chase any headlines to make any money. But River, I don't know if you have something to say to that, but I see it way too often
Oh,
on the trade floor.
I 100% agree. And then one of the biggest issues that I see is that um, people are analyzing news and data that they don't actually understand, which is 100% fine. Like I love reading market fundamentals. I love reading the jobs reports, CPIs, PPIs, all of that stuff. I love to read those reports and know what's going on. Um, the market doesn't, if you just look at it and like today, terrible job numbers, we've realized that we've actually been losing jobs 4 out of the last 3 months. We are in stagflation right now. Market does not care. So if you do have that bias, stagflation, government shutdown, fine. But where people really struggle is they get so obsessed with something that they don't quite understand that they can't shake their bias. And bias is the killer of ports. Like, do I think the market should have ripped $6 or whatever it did today when they tell us that we're losing jobs, not gaining jobs in America? No, but that doesn't matter. The market went up. So we, like you said, you go to the chart. News will have its effect. It will be relatively quick, and then you go trade the chart. So you can't just think you know everything. And don't get me wrong, like I don't know this, like I don't know what a lot of this stuff means. It's well beyond me. I just like to read it. But if I'm wrong on my opinion of how something's going to happen, then I will 100% admit I'm wrong and move to the other side. But we see it on Trade Floor all the time. Shout out Norvin. He thinks the end is, somebody jaywalked and the SPY's going to crush 4% or whatever. I don't know what to say.
Gotta love it. All right, we got 15 minutes left in the class, so we got to keep rolling. But again, great conversation. Let's see. Let me remember this one. Okay, yeah. So this is a little bit more related to position sizing, and this was a direct quote. I forget from who. Maybe this is Al Brooks or somebody else. I don't know. Risk only a small fraction of your account on any one trade, so that a series of losses won't matter, right? And somebody mentioned it earlier. So does this mean don't full port swing trades, right? Well, if you take a couple losses and you're full porting every time, you take 2 or 3 losses and all of a sudden, your port's gone, right? If you're sizing a lot smaller, maybe even 10% of your port, which is still pretty significant, but a whole lot smaller, you could let 10% of your port trades go to zero and you're not doing too bad, right? It's gonna hurt. But you at least have more than half of the money that you started with. But anyway, I don't know if there's too much to cover here, but any other thoughts, guys?
I love that. And one thing I do want to point out that, everybody talks about full porting, like one trade.
Oh shit.
If you have 80% of your port in trades, even if it's not one, you are also full ported and are at the exact same risk of somebody else who full ported one trade. It doesn't matter. You guys have the same amount of capital against you. And what if the market turns around? I mean, we saw it last week, where, SPY pulls down like 1% and trade floor was obliterated because they were full
Correct.
ported in all long trades and SPY pulled back. I don't remember even what, 8
There's a
months?
3-day pullback right here.
Yeah.
Right
Was
here.
like, did it? I don't
1,
even,
2, 3, it dropped.
and people
Not
were
even 2%.
obliterated. And
Wrecked.
they
People are
were
like, I blew
obliterated.
my port.
Yeah, I blew my port. And if you can't handle, like the market will pull back. Like the market's given a few pullbacks that haven't been big this year, but the market will always pull back. And so if you have all of your port in trades, then these 3-day pullbacks can kill you. And all of a sudden, your port's down 20, 30, 40%. And, each trade might only be down 20%, like not a huge loss. But when you have all of them, all of a sudden your port is wrecked. And so full porting is not just one trade. Full porting is also, it can just be all of your port is involved in the market, which is the riskiest thing you can do. I mean, like any successful day trader, hedge fund, market maker, any of them, they have minimal cash or, minimal stocks and minimal allocation into the market. All big money, all good traders sit on a pile of cash most of the time.
And I think another interesting thing too is that traders like that, and this is something I wanted to mention earlier, sorry to interrupt you, but I think it's relevant.
Yeah.
Traders like that, professional money managers need to know exactly how much money they have at risk at any given moment, right? Because if the market crashes, they need to know, okay, we'll only lose 7% due to our stops. So I just wanted to mention that. I learned that recently. I found that fascinating.
Yep. And hedge funds also do a thing right before close. Part of market on close imbalances is they try to land what is called delta neutral. So they will have exposure long and short overnight where they don't care what happens overnight. They end up break even the next morning. That's what matters to them is always capital preservation. And I think that's what most people miss in here is, they still have the idea of if I'm not in a trade, I'm not making money. But in reality, they need to look at the other side and say, if I'm not in a trade, I'm not losing money. And when you really start hammering down on only very good setups, you don't have, 15 swing trades open and you got a couple day trades, maybe you're scalping while you're doing it. And one thing leads to another, all your buying power is gone and you are full ported, and you never want to end up like that.
No. 1K, we haven't heard from you for a little bit. Anything else on this one before we keep rolling?
I don't know. I'd just be kind of repeating the same stuff. I mean, you guys are doing a good job, man. I'm still here, but honestly,
All right,
nothing
cool.
really to add, man.
Cool. Okay, this one I think we already kind of covered. Minimize your position sizes when market conditions are unfavorable. I guess just a reminder that cash is absolutely a position, kind of like River was saying. We'll keep rolling. All right, this is a little bit about selling. So we've talked about managing risk when you're losing. We've talked about managing risk and when you're entering and getting in trades. Now I want to talk a little bit about managing risk when you're in profits, actually. And a lot of you might not think, that there's any risk that you're in profit, right? But fundamentally, another goal as traders, right, is to minimize losses and maximize profits, right? That's the trader's equation. You have to have large profits and small losses in order to be profitable. There's only two variables, right? And as long as you can master those two things, it's pretty straightforward. So I wanted to talk a little bit about selling and actually making sure that you protect the profit that you hopefully earn on a reasonably frequent basis. First one is raising stops to protect profit. And 1K, I'll let you start this one out. Anything to add on this one?
Yeah, I guess my day-to-day week. Obviously I was out last week and a little bit this week, but like yesterday I traded PayPal, made some profit. Today I alerted a Walmart, made some profit. So my mindset for the week is usually be very, very conservative during the week. So my first trade, if I send it out in the tab and we're making money on it, first things first, my stop is on at my stop out where I say, okay, the stock moves in our direction we want. Today's Walmart puts. It's down to target one. What do? I immediately move my stop to my break even point. No questions asked. Sometimes you get stopped out, that's fine, but at least I'm not going to lose money on that. And then if it moves down to two, then I move my stop loss to target one. And in doing that early in the week, so let's just say this was a Monday trade. I know it's Wednesday, but I trim like 3/4 my position size at target one because you know, copyright trademark from River is I'm trying to end the week green. So if it's the first trade of the week and it's a profitable trade, I need to book some profits. I can't be greedy because I need to start, I want to start the week out right. And so that first target, I trim pretty heavy and I'll leave a couple runners, just let the play out. It's kind of a confidence booster. Then during the week, I got that little bit of a buffer. Let's just say, today's Wednesday and I alerted Walmart. But let's just say it's like the third trade of the week. Well, now I got a little bit of wiggle room. So when that next trade, if it goes in my favor, when I trim at target one, I'm not going to say I'm reckless. I'm just a little bit more loose and letting plays play out a little more to try and
Right.
book some extra profit. So I may just trim, half that. If I was in, 6 contracts, I may just take off 3. And so it just trickles down each day. And one thing River taught me early on is like I open up the port for the week, like today. I know, again, I haven't been trading 3 days this week, but I look at it and say, okay, I'm up this amount of dollars this week as of now. And like I keep that in my head. And then when it kind of backtracking to stuff we talked about is I cannot lose, more than that. Like you just can't do that. You can't work all the way up till Thursday, and then Friday we're having fun on zero DTs, and then you check back on your port, you're up 400, now you're down 200 on the week. Like 4 days of work just wiped out. You cannot do that. And so as the week goes on, to kind of summarize, I reduce risk, and I just try and add to that profit if I am profitable in the week.
That's awesome. I love that. Very, very cool. Yeah, that's an excellent way to think about it, 1K. Yeah, I mean, I've been doing something reasonably similar. Unfortunately, it chokes trades off sometimes, and I think there's kind of a balance between that. One that I actually got stopped out of yesterday, which kind of hitting myself for today, was actually run. And I was in this one at 1690, moved up to this trend yesterday, rejected, and I actually forgot, I didn't even remember this, but I had set my stop a cent above entry after the name moved about 5% in my favor. And I'm trading shares, decent position size, so 5% in my favor is, not a sum of money that's something to look away from. So I set a stop at break even and actually forgot about it, which is my own mistake. And I got the alert that I got stopped out today, and I was like, oh man, that kind of sucks. Or yesterday. And then of course today the name moves what? Yeah, 20% up from my entry, rejected, so I don't feel as bad. But there's definitely a balance, and usually I don't keep my stop on the book like that, but this was just a name where it did happen to be the case. But I still stand by the principle. I had a name that I made a decent amount of profit in, didn't really trim anything, and just wanted to sit tight for a little bit, and ended up coming back and stopping me out in this case. But it's really not the end of the world, and it's still not a losing trade, and generally following my rules there. Another one that's been fun, just another practical example here, is this LEU. And all I've been doing here is trailing my stop up with the moving averages. That's it, right? I took some the position off early, sold a half here and another eighth into this breakout, and then sold another eighth on this rejection as well. And now I just trail it with the 10 EMA, right? So you can kind of see how I move my alert up. As the 10 EMA moves higher, I trail my stop up. And that basically helps to make sure there's absolutely no possible way that I'm going to lose too much money, right? And too much profit. And I mean, right now it's got a decent distance from the EMA, about 10%, which that's pretty significant. But with a name like this, that's kind of the nature of it. So anyway, we got a couple minutes left. I'm going to keep rolling. This is another lesson that's pretty much in the same vein of things, which is sell into strength. A lot of you definitely have trouble with this. You don't want to be selling when you have to. You want to be selling when you can. And that's one of the most impactful quotes that I have heard over the last couple of years. And I'll say it again, because if you learn nothing from this lecture, I hope you at least take this home with you. Sell when you can, not when you have to, right? Some examples of when you can sell are into strength, into key technical levels, when you plan to sell the given spot. Some examples of areas where you have to sell are when a name starts breaking down, when you have to stop out, right? When a breakout fails. There's certainly a balance, right? Just selling into strength doesn't mean, sell at the first sign the trade is up. Like for me, this specific trade is one I took recently. If I sold the first day into strength, I would have really choked the trade off, right? So there's certainly a balance. I ended up selling into strength once we started to extend a little bit into the prior resistance level and take a little bit off. Yeah, so anything. Anyway, 1K Luigi, anything else to comment on there?
Nothing for me.
Not for me, sir.
Cool. All right, we got a couple minutes left. Setups. So this is one where it's important to understand the type of trade and the potential risk reward in any given trade that you're taking. And this is something that River was alluding to a little bit earlier. And what I have noted here, ooh, this is actually the last one, perfect timing, is to seek asymmetric setups. And what this means is that you should be looking for setups that have more room for you to make money than lose money, right? And this comes down to your risk to reward ratio, where in general, very general rule, your profit target, your first profit target should be approximately twice your risk, right? And again, super, super flexible. Sometimes it looks like 1.5 to 1, maybe sometimes a little bit different. But in general, very loose rule of thumb, you want that risk to reward ratio to be 2, meaning that you would profit twice as much as you would lose on any given trade. And the most fascinating part about this sort of asymmetric ratio is that you could lose 66% of the time, approximately, and break even with a 2-to-1 risk to reward ratio, right? Because for every 2 losses you take, that's just 1 gain, right? So you could be wrong less than half or more than half the time, basically even worse than flipping a coin, and you could still at least break even. So asymmetric setups certainly can be incredibly powerful, especially when you're trimming into that first target and setting a stop and giving that trade room to run significantly more in some cases, right? And there's a time and a place to do that, kind of like 1K mentioned. And this is our last lesson of the night. Oh, looks like Nando posted. I think I've seen Nando post this before. Yeah, this is a good reference. Okay. Yeah, Luigi 1K, anything else to add? We're right at time here. Somehow perfectly made it to the end. Yeah, any last comments, gents?
Nothing.
Nothing from me. I think that although overly simplified, I think it's really, really important for new members to browse through the analyst guide to get to know all the analysts and their preferences in trading so that they're not blindly following somebody that's may not best suit their you know daily capabilities in terms of being able to trade, get in and out of trades. I think that's you know I like to know who I'm going to be following, who is closest in terms of his training style to what I'm able to do if I was a member. So I think it's important to just revert back to that and just highlight that for the new members that probably haven't seen that since I believe the last time that we shared that with the members was back in July. So just put that out there too.
Yeah, that's a great point, right? I mean, the way some people trade isn't going to align with the members, right? River being a scalper, he's in and out pretty quick and taking, 10, 20, 30% gains most of the time. And that might not work for some people, right? Scalping is pretty quick. Luigi, somebody like you, maybe is spending a little bit more time in some of your positions, maybe a couple days, a week, 2 weeks, and some people might not be patient enough to be able to handle that. And maybe that's a separate conversation, but yeah, certainly agreed with you there. Okay, everybody. Well, that really brings us to the end. Just to kind of summarize what we talked about tonight, very simply put, we reviewed some of the most significant principles of risk management in financial markets. One thing that I didn't mention is a lot of the principles that I talked about, while they're certainly shared by everybody who participated in the class today, it's also a lot of these lessons are derived from some of the greatest, most successful traders of our time. I think it goes without saying that, 1K and myself, Luigi, while we're certainly, decent at trading and reasonably successful, I'm not going to act like we're the most legendary traders and have the most accolades. And as a result, it's important for us to learn from the people who do have, 30, 40, 50 years experience, who are, wildly successful. And every single one of these principles is directly derived from that sort of traders. So anyway, I just wanted to mention that. As kind of a wrap up here, we just finished lecture 9 of the intermediate course series. We have 3 more to go, and I'm hoping to get a good group of analysts in for the last 3. We have trading psychology coming up next, which should be another really, really powerful one. Strategy development. So hopefully we're going to get the opportunity to talk about different analyst strategies and how they trade. So maybe we could save them having to read the guide there, Luigi. That could be pretty cool. And we'll talk a little bit about how everybody does their thing and give you guys some different options and understanding for how people operate. And then finally, our last lecture of the intermediate course series is going to be portfolio management, where we talk about the types of trades that you take, the balance of different sectors and names and hedging and all those sorts of things. So we got a really, really strong last couple lectures of this course series. So looking forward to it and I hope you guys are well as well. And again, make sure to show some love to Luigi and River and 1K for making the time tonight. By no means did they have to be here. They chose to be here. And as a result, certainly make sure to give them a nice message if you can and have the time to, because I like to think they added a lot to this lecture and hopefully made it even better for you guys too. So With that, that's going to do it for tonight, everybody. As always, if you have any questions or comments, you can feel free to message any one of us on the team, and we're all going to be happy to respond and help you out. We got a couple questions. Where do you find in the Discord which analyst does what? You should tag the Only Options Trades account, and they should be able to help you find that. There's also a welcome guide. Oh, I just downloaded the PDF. There's this welcome guide here, and this should help as well. So this is a little bit out of date, but it helps to talk a little bit about some things in the group. So this talks about what each analyst is doing. And if you want, you can take a screenshot of it too, just to make sure you have it. Cool. All right, everybody. Thanks again for your time. Really appreciate it. And we'll see you guys all in the next one. Adios.